Hello, dear CA CMA final friends. How are you guys? Dear friends, from today we are starting to provide you guys the detailed revision lecture for CA final as well as CMA final direct taxation for your upcoming exams. And okay, these classes are applicable for May 2026, September 2026, and Jan 2027 for your CA final. And if you talk about CMA, then for June 2026 as well as December 2026. Sir, will you provide 100% of the revision lectures? Yes, dear. We are going to provide you 100% revision lectures, and these lectures will be uploaded on a regular basis. So you will get all the lectures. Okay. Before moving into lectures, let me talk a bit about your applicable years, basically. Sir, we are also getting some news that a new income tax act has become applicable. Yes, dear, that's true. A new income tax act has been applicable, and means it will be applicable from 1st April 2026. It is called Income Tax Act 2025. So then, sir, our exams are going to be affected by that new law? No. If your exams are in these three attempts, or if your CMA final, and if your exams are in these two attempts, then the new income tax act is not applicable on you. For CA final, the new income tax act is applicable for from May 2027 onwards, and for CMA, the new income tax act is applicable for June 2027 onwards. Okay. Before moving further, let me talk a bit more about your applicable assessment year, previous year. Dear friends, for these all three attempts, the applicable Finance Act is Finance Act 2025, means Budget 2025. For you guys, the applicable assessment year is 2026-27, and the applicable previous year is 2025-26. But sir, we are also getting some info that these assessment year and previous year has now been scrapped. No, dear, this is not the case. Yes, once the new income tax act will become applicable, these two are going to be merged, and a single term will be used, which is known as tax year, which is known as tax year. But this is not the case for your exams. This is applicable for your juniors, then when they will appear in the exams. Okay. Now okay, now without wasting any more time, so for you guys, for the for the CA guys, the applicable Finance Act is Finance Act 2025, applicable financial year, financial your FA 2025, assessment year is assessment year 2026-27, and the previous year is 2025-26. Okay. And one more thing, for your May 2026 exams, the amendments of up to 31st October 2025 is applicable. Although in our books all the amendments have already been incorporated, but ICI releases a statutory update booklet. Till now, that booklet has not been released. I was waiting for that booklet. That is one of the reason that why it has taken so much time to bring these revision lectures. But till now, no such revision videos. No such statutory update has been released either by ICI or ICMI. So when those statutory updates will come, I will make a separate video on those. But one thing is for sure, that everything that we are talking about, most of the statutory updates have already been incorporated in our classes, so you are not required to be much more to be very much concerned about those. And once the updates will come, I will make the separate. Okay, now before proceeding, everything we have covered. Yes, sir. For CMA, for you guys, the same Finance Act 2025 is applicable. The same assessment year, the same previous year, but for you guys, the amendments up to 30th November 2025 is applicable for June 2026. Once the CMA Institute will release the amendment list, I will provide a separate amendment video. Okay, before moving. As I have told you guys, these revision lectures are 100% in English. We will also upload, or we have started uploading the Hindi plus English version also. So those guys who are comfortable with Hindi plus English version, they can watch those videos, and those guys who are comfortable with 100% English version, they can watch this batch. Okay. Now. So today is the first lecture introduction and basic concepts. Here we are talking about four main important aspects. First is the tax rates, and the second is the surcharge rates. The third one is the salary aspect as well as the house property aspect. Dear friends, salary and house property head are not very much covered in your syllabus, but the institute has given certain portion of salary as well as house property in the syllabus. So all those portions which have been covered by the institute, I will discuss. I will revise all those. Okay. So now we are finally moving towards the revision video. The revision. Okay, Constitution of India and Indian Income Tax Act. These are not the relevant areas for our discussion. Okay. Before moving to tax rates, I will revise these two case laws. These are from your study mat. So these cases are covered in your study mat. Okay. So if you will ever refer your study mat, you will find these. Okay. So from here we are going to start the revision. Okay, dear friends, before proceeding into the revision, one more thing that I would like to talk about. Dear friends, for many students, the Jan 2026 exams was a bit on the higher side, means a bit of the tough side. So I have not made any video about what was the level of Jan 2026. Okay, but one thing there is for sure, the level of exams of both your CMA, CA and CMA exams are going to be up, and we have to ensure that our preparation level is also of that kind that we will meet the expectation of the institute. Okay, so with these words, starting with the revision. Okay. So this is the first case: liquidation damage received by the company from the supplier for failure to supply machinery to the company within the stipulated time. Okay, so this is the first case. The case is liquidation damages received by the company from the supplier for failure to supply the machinery to the company within the stipulated time, a capital receipt or revenue receipt. Dear friends, before moving to this case law, I will talk a bit about some of the basic aspects. So, dear friends, always remember, in income tax, what this income refers? Sir, the income has been defined in section 224. No, I am not talking about this. What does this income refer? This income is of revenue nature income, or this income is of capital nature income. Sir, what do you mean by revenue nature or capital nature? Revenue nature income is those kind of income that are of the recurring income. A recurring nature means that keeps on coming and coming and coming, like your salary income, like your business income, etc. Okay, means those income which arises in the ordinary course of business is something a revenue nature income. And what is capital nature income? These are the income that may occur, that may not occur. Means there is no regularity, there is no certainty that such income will occur. Like, I have won some lot. I have got some lottery. I have earned some capital gains. So these are the income which are of non-recurring in nature. This income may occur, this income may not occur. So these are non-recurring nature income. These income do not occur arises in the ordinary course of business. Are you guys getting that? Okay. So as far as Income Tax Act is concerned, always remember, all revenue nature income is taxable. If any income is revenue nature income, it is taxable until and unless there is some special exemption has been provided. Okay, if there is some capital nature income, it is not taxable. Sir, what you are talking? We have already seen the capital gains. Okay, so the capital nature income is not taxable. The capital nature means capital receipts are not taxable. Those income which do not occur arises in the ordinary course of business of the SSE is generally not taxable. It is taxable only if there is specific inclusion. What I mean by the term specific inclusion, like capital gains. Income Tax Act specifically says to tax the capital gains. That's why we are taxing it. Income Tax Act specifically says to tax the gift. That's why we tax gift under section 56 to 10. Are you guys getting? So what is the general law? The general law is that a revenue nature income is taxable. In all cases, if the specific exemption has been provided, then it is not taxable. a capital receipt, a capital kind of receipt is generally not taxable until and unless there is a specific inclusion, there is a specific provision to tax that income. Are you guys getting? So let's say if I got some income, if I get some income which is of non-recurring in nature, so the income, if the income is non-recurring, what it implies, that income is basically what? A capital receipt. So what department will try to prove that, sir, this income is of revenue nature? Why? Then so that the assessing officer can tax that income. But what I will try to prove, no sir, this income is of capital receipt, hence it should not be taxable. If there is no specific provision to tax it. Are you guys getting? So there is a constant tug of war which goes on between the assessee and the department for non-ordinary business receipts. That the department says it is of the revenue nature, hence it is going to be taxable, while the assessee says no sir, it is of the capital receipt, it is of the capital receipt in nature, hence it should not be taxable. Are you guys getting? Okay, so that's the cases on. And this case is from your study material. I am not teaching anything, or I am not making you guys revise anything from my side. Are you guys getting? Okay. So what happened in this case? This is a very important case. CRT versus Saurashtra Cement. What happened in this case is that, let's say there is a buyer, Mr. A. He's a buyer and he's a supplier, Mr. B. So Mr. A and Mr. B has agreed where Mr. B will supply the machine, to Mr. A. So as Mr. A has placed the order to Mr. B to supply the machine, and Mr. B has committed to supply the machine, let's say within 30 days. This is, I am saying you from my side, within 30 days. Let's say Mr. A has got the commitment from Mr. B that he will supply the machine after 30 days. Okay. Then what Mr. A has done, he has hired a factory, hired a place where he is going to put the machine. He has hired the workers. He has purchased the raw material, etc. So that once the machine will come, the work will start immediately. Are you guys getting? Okay. But happened what? Mr. B has not supplied the machine to Mr. A within the intended time, as per the intended schedule, as per the pre-agreed schedule. Mr. B has not supplied machine to Mr. A within the specified time limit. Mr. A has suffered some losses because he has already hired some premises and he is paying the rent. He has already hired the workers and paying them salary. He has already purchased raw material, and if the machine will not come, those raw material may get waste. Are you guys getting? To compensate Mr. A, now listen very carefully. To compensate Mr. A, Mr. B has paid some compensation, some money known as liquidation damage. Mr. B has paid Mr. A some liquidation damage. Are you guys getting? Okay, so the money has come. Means money has come, and as the money will come, who will arise? Sir, assessing officer. Assessing officer has reached Mr. A and has told Mr. A that Mr. A, you have got the money. Okay, now as you have got the money, give us our share. Sir, what do you mean by the share? Okay, give us the tax basically. Okay, so give us the tax. What Mr. A will try to prove, sir, this money is basically what? Capital receipt in nature, because it is not an ordinary business receipt. But what the department will try to prove? No, this is a regular business receipt. Hence, you have to pay tax on it. Are you guys getting? The matter escalated and finally reached to the Supreme Court of India. And what Supreme Court has said? Okay. Now, read very carefully. Such liquidation damages are directly linked with the procurement of a capital asset. Mr. A wanted to procure some capital asset. Mr. B has not supplied that capital asset to Mr. A within the stipulated time, due to which Mr. A has suffered some losses. If, let's say, Mr. B has supplied the plant and machinery to Mr. A, Mr. A have used that plant and machinery in his business purposes, have earned income, have earned money, and on that money Mr. A was paying taxes to the government. Here, why Mr. B has given money to Mr. A? Because Mr. A has suffered some damages due to the non-supply of machine from Mr. B to Mr. A within the stipulated time. Are you guys getting? Okay. So now what Supreme Court said? Why Mr. B has paid money to Mr. A? Because Mr. A had suffered some losses which led to delay in coming into existence of profit making activity for the associate company, means Mr. A. Mr. A had suffered damages because of the non-supply of the machinery by Mr. B on timely basis to Mr. A. Okay, such receipts are not in the ordinary course of business. What the department was saying that, sir, Mr. A, that for Mr. A it is the regular business receipt. What Supreme Court said, no, this is not a regular business receipt because you cannot expect such kind of receipts in the ordinary course of business. Okay, hence it is capital receipt in the hands of assessee, hence not taxable. So finally, Supreme Court said that no, sir, this amount is not to be taxable. Okay. The related second case, the Honda CL Car India Limited. This is again a very interesting case. Here, what happened? There is an Indian company. There is an Indian company. There is an Indian company. This Indian company has paid some money to the Japanese company and say 100 crore rupees. And for this money, against this money, this Japanese company will help the Indian company, the Indian company in setting a factory in India. This Japanese company will help the Indian company in setting a factory in India. It will provide, the Japanese company will provide the Indian company the technology, the intellectual properties, the know-hows, the formulas using which the Indian company will set up the factory in India. Are you guys getting? Okay. Now, what was the issue? The issue is that this Indian company says this amount is a revenue nature expenditure, hence this Indian company wants to claim it in one. It said that I want to debit this entire 100 crore rupees in my P&L account and I want to claim it as a business expenditure. Dear friends, remember or recall from your 11th standard, 11th class, what was a revenue expenditure? A revenue expenditure is an expenditure which do not have an enduring benefit and which usually have a life cycle of 1 year. If I incur some expenditure which has some enduring benefit for me, can I call it or can I treat it as a revenue expenditure? No, sir. It is a expenditure of capital nature. Here, by paying 100 crore rupees, this Japanese company will help the Indian companies to set up a factory in India, and this factory will provide a long-term benefit to the Indian company. Means this 100 crore rupees will provide the enduring nature benefit to the Indian company. Are you guys getting? So, can I say that this 100 crore rupees are revenue nature expenditure? No, sir. So it is not a revenue nature expenditure. Means if it is not a revenue nature expenditure, I cannot claim it as a tax deduction. It's tax deduction in one go. Okay. Then, sir, what will happen with this? This will be treated as a intangible asset or license fees kind of thing, and I can claim depreciation at the rate of 25%. Okay. Here, read here. The very purpose of the technical collaboration agreement was to set up the joint venture company in India, which has an enduring benefit. So these two words are very important. Therefore, the technical fees paid by the associate cannot be claimed as a revenue expenditure. So the amount which has been paid by the Indian company to the Japanese company, it cannot be claimed as a revenue expenditure. Okay. So these were some case laws which was given in your study mat. Okay, now we are finally moving towards our main revision. Okay, dear friends, now we are starting our main revision and we will start with the revision of the income tax rates. Dear friends, the very first thing that we are going to revise is the tax rate for individual, HUF, AOP, BOI and artificial juridical person. Okay, for all these guys, for individual, HUF, AOP, BOI and AJP, there are two tax regimes you guys know very well. One is 115 BSC and another is the optional regime or normal regime, or you can also say okay, optional regime or normal regime, and this is default regime. So there are two regimes. One is 115 BSC or default regime and another is the optional regime or normal regime or the regular provisions. So these two have different rate of taxes. So first we are going to revise 115 BSC. Okay. So what is the tax rate for 115 BSC? If your total income is up to 4 lakh rupees, nil rate. If your total income is from 4 lakh 1 to 8 lakh 5%, 8 lakh to 12 lakh 10%, 12 lakh to 16 lakh 15%, 16 to 20 lakh 20%, 20 to 24 lakh 25%, and above 24 lakh 30%. So this is the tax. This is the tax limit. So again, 4 lakh rupees nil, 4 to 8 lakh 5%, 8 to 12 lakh 10%, 12 to 16 lakh 15%, 16 to 20 lakh 20%, 20 to 24 lakh 25%, and above 20 lakh it is 30%. Okay. So, but sir, I we have read some in some news that up to rupees 12 lakh you don't have to pay any tax, but here only rupees 4 lakh is exempt. And after rupees 4 lakh the tax rate is 5%. Dear friends, what you have read in the news was right. Up to rupees 12 lakh there is no tax payable, that is true, but this is available by a rebate under section 87. We will discuss about the rebate in a bit. Okay. So this is the tax slab that you have to remember. So you have to remember each and every particular tax rate. It is not very difficult. You can easily remember. You have to remember the 4 lakh slab basis, 5.555% slab rate. So 0 to 4 nil, 4 to 8 5%, 8 to 12 10%, 12 to 16 15%, 16 to 20 20%, 20 to 24 25%, and above 24 30%. But you guys are not going to get a full-fledged question of calculating the rate of the income tax for the individual in your CA final level. So here's a shortcut. If your total income is up to rupees 24 lakh, all these tax slab will give you a tax of 3 lakh rupees. Okay. And if your total income is above than rupees 24 lakh, then how you are going to calculate the tax? 3 lakh rupees plus total income minus 24 lakh into 30%. So let's say if your total income is 25 lakh rupees, then how I am going to calculate my tax as per 115 BSc slab rate? So 3 lakh rupees for first 24 lakh, and beyond 24 lakh 1 lakh rupee into 30% means 30,000 rupees. So the tax will be 3 lakh 30,000 rupees. I hope you have got the point. So here is the simple formula. Okay, so this is the tax slab for for individual HUF, AOP, BOI, artificial juridical person, which is given by section 115 BC. And yes, the individual and these guys can be a resident, can be a non-resident, can be male, can be female. Okay. Okay, one more thing. These tax rates are only for the normal income. If you have earned any income for which a special rate of tax has been provided by Chapter 12 of Income Tax Act, then such income is going to be taxable at those rates. Yeah, okay, just like for example, if Mr. A has earned some lottery income for which a 30% tax rate has been provided, or Mr. A has earned some income from online gaming for which 30% tax rate has been provided, then those income will be taxed at those flat 30% rates and not by this rate. Means, sir, what you want to say? Okay. For example, let's say Mr. A has earned rupees 4 lakh in a year, and that income was from a lottery. He has not done anything in his life. He has just whatever money he has invested that in a lottery, and he has earned a lottery. He has got a chance, and he has got rupees 4 lakh from a lottery. So he have only one income, 4 lakh rupee, and that too from a lot. So are we going to apply this provision and say that if your income is up to rupees 4 lakh, the rate of tax is nil, and hence your income tax is nil? Answer is no. Because, sir, why? Because this income is from lottery, and for lottery income a separate rate of tax has been provided. Casual income in nature, section 115 BB, as far till my memory serves me right. Section 115 BB says the lottery income, the casual income, is taxable flat 30% rate. So, although you don't have any other income for these 4 lakh, but for this 4 lakh rupee, you have to pay tax at the rate of 30%, means 1,20,000 plus 4% health and education cess. So, this is 124,800. So, this is the tax you have to pay. Means, then, sir, what is the relevance of this slab rate? This slab rate is relevant only for those income for which no separate tax rate has been provided under Chapter 12 of Income Tax Act. And if for some income there is a separate tax rate has been provided, then that income is going to be taxed at those rates and not by this slab rate. I hope I am clear. Okay. So this is what we have written here. The above tax slab rate is applicable on income other than those chargeable at a special rates under Chapter 12 as Section 111A, short-term cap gain, 112 LTCG, 112 LTCG, 115 WB lottery income, 115 WBJ, most probably online gaming. Okay. Again, very important, sir. If you are in the default regime, then there is certain conditions, there is certain restrictions that you have to comply. You can't claim the deduction for leave travel concession, means section 10(5) exemption is not available to the associate who is under a default regime. 10(13) a house rent allowance exemption he cannot claim. 10(14) he cannot claim the special allowances, the exemption for special allowances. 10(17) he cannot claim the daily allowances or constituency allowances for MPs, MLAs. 10(32) he cannot claim exemption in respect of minor child income clubbing in the hands of parent, which is of 1500 rupees per minor child. He cannot claim, now this is important because these are basically for C-enter. He cannot claim 10AA. So if you are export oriented unit located in SCZ, and if you are exporting and if you are earning the income from export, then section 10AA provides you deduction for 100% for first year, first 5 years, 50% for next 5 years, and another for some 5 years if you invest money in the SCZ reinvestment reserve account. But if you are in the default regime, you cannot claim this. You cannot claim the deduction for entertainment allowance, you cannot claim the deduction for professional tax, but yes, you can claim the standard deduction of rupees 75,000, means 75,000 rupees standard deduction of. This is BVI. You cannot claim interest on loan in respect of self-occupied property. So if the assessee is in the default regime and he has a house property which is self-occupied by him, and if he has taken a loan for the purchase, construction, repair, etc. of the house property, he cannot claim the interest as a tax deduction expenditure if he is in the default regime. If the house property is self-occupied, there are two important things. Okay, house property should be self-occupied. If the house property is let out or deemed to let out, if the house property is let out or deemed to let out, then he can claim interest deduction as per the provisions of the act. But if the house property is self-occupied, he cannot claim any interest deduction. Another thing is, if he wants to claim the deduction for interest in interest on loan in respect of self-occupied house property, then he have to opt out from default regime, and if he opts for the optional regime, then he can claim the interest up to rupees 2 lakh in respect of loan taken for purchase or construction of the house property. I hope you guys have got the point. Okay, very important, he cannot claim additional depreciation, he cannot claim the deduction for tea, coffee, rubber development account money that he has invested. He cannot claim section 33 ABS height restoration fund. He cannot claim anything under scientific research, donation made. Dear friends, there are two kinds of expenditure that you can incur on scientific research. One is for in-house expenditure on scientific research. Another is donation mode. In-house, you can incur expenditure in the nature of revenue nature and capital nature. Revenue nature expenditure is allowed as deduction under section 35(1)(1), and capital nature expenditure is allowed as deduction under section 35(1)(4). Dear friends, be very clear. Whether you are in the default regime or optional regime, these two expenditures are allowed in both regimes. These two expenditures are allowed in both regimes. But as far as the donation made is concerned, this is allowed only in optional regime. If you are in the default regime, you cannot claim the expenditure for the donation you have made for scientific research. Okay, the donation can be made to any notified approved research association, approved Indian company, any notified research association, approved national lab, university, IIT, or any specific person. Okay. Apart from this, you cannot claim the investment linked tax incentive for specified business under section 35 AD. You cannot claim deduction in respect of expenditure incurred on notified agriculture extension projects under section 35 CCC, and you cannot claim etc to ATU except 4 sections. What are the 4 sections which are allowed as deduction? ATCCC 2. Sir, what? ATCCD 2. Sir, what is this? Employer's contribution to the NPS account of the employee. So, if your employer is contributing any amount, for the employer's contribution portion, you can claim the deduction even in the default regime under section 80CCD 2. Central government contribution towards Agnipath scheme of Agniveer under section 80CCH 2. Deduction under section 80 JJA for new employment that you have provided, and if you set up a unit in IFSC, then you can claim deduction under section 80L. Okay, so these are the conditions. If you remain in the default regime, you have to comply with this. Okay, Apart from this, if you are in the default regime, then you cannot carry you cannot set off any loss or any depreciation if these losses or depreciation belongs from any of these, such as like for example, let's say assessee was in the optional regime and he has purchased any plant and machinery, in this plant and machinery he is eligible for 20% additional depreciation, but as put to use was for a period less than 180 days, then he was allowed only 10% of the additional depreciation in the year of acquisition. The next 10% was allowed in the succeeding year. Let's say in the succeeding year assessee has opted for 115 BSc. Sir, how he can opt for? Okay, he remained in 115 BSc. He has not opted out from 115 BSc. Then, as he has 10% of the additional depreciation unallowed. Now, as he remains in 115 BSc regime, he cannot claim this additional depreciation. This will lapse. This will lapse. This will become a dead expenditure. Okay. Proceeding further. Okay. If you remain in 115 BSc regime, the maximum rate of depreciation that will be available to you will be restricted to 40%. Dear friends, there are some depreciation rates which can go up to 45%, but if you remain in the 115 BSc regime, then this rate will be restricted to 40%. Okay. Okay, then sir, there are a lot of restrictions in 115 BSc. Dear friends, there are few benefits also. Like in 115 BSc, the slab rates are of lower side. In 115 BSc, 80 AMT means alternate minimum tax liability is not attracted. And in 115 BSc, the highest surcharge rate is 25% instead of 37%. So there are some benefits also. Okay. Sir, being an employer, how I will know that whether my employee is going to be in 115 BSc regime or he will opt out? Then how will I calculate his salary income and make TDS under section 192? Dear friends, this is an issue. So CBDT has issued a circular, and in this circular, CBDT has said the employer to ask the employee about his intended tax regime. So the employee has to inform his employer in which tax regime the employee wants to be. And if the employee do not give the information about his intended tax regime to the employer will presume that the employee will remain in 115 BSc regime, and the employer will accordingly calculate the income of employee considering 115 BSc regime and make TDS under section 192. Okay. So here, if the intimation is not made by the employee, it will be presumed that employee continue to be in the default tax regime and employer shall make TDS accordingly. Okay. This is the illustration which tracks as a total income of 16 lakh comprising income from house property and interest on FD. Dear friends, why these words are important? Understand why these words are important: house property and interest on FD. Because interest from house property is a normal income, because there is no specific tax rate has been provided for this house property income, as well as interest on FD is a normal income. There is no specific tax rate has been provided for this income. It means both these income are going to be taxable at a normal rate, means 115 BSc slab will be applicable. So if my total income is 16 lakh, how much my tax liability will be from 0 to 4 lakh? Then 4 to 8 lakh, 5% means 20,000. 8 to 12 lakh, 10% means 40,000. And 12 to 16 lakh, 15% means 60,000. Means 1 lakh 20,000 plus 4% health and education says 4,800. So 124,800. Okay, so we have concluded 115 BSc. Now we are moving towards Finance Act 2025. Means for optional regime. Optional regime is also sometimes referred as normal regime or regular regime. Okay. The slab rate for assessment year 2026-27 applicable to individual HUF, AOP, POI, artificial juridical person. Dear friends, there is one important, or there's one good news. For last many years, the government has not changed the slab rate under the optional regime. So that is easy for the students, because they they can easily remember. First is the general slab, where the total income is up to rupees 2,50,000 nil. 2,50,000 to 5 lakh, 5%, 5 lakh to 10 lakh, 12,500 plus 20%. So remember, from 5% directly 20%, there is no 10%. And from and income exceeding rupees 10 lakh, 1 lakh 12,500 plus 30%. So from where this 1 lakh 12,500 figure came, if my total income is exceeding 10 lakh, then it must exceeded 2 lakh 50,000. Yes sir, it must exceeded 5 lakh, means first 2 lakh 50,000 to 5 lakh, 5% means 12,500, 5 lakh to 10 lakh, 20% means 1 lakh. So this 1 lakh 12,500 is for first 10 lakh rupees. So first for first 10 lakh rupees, 1 lakh 12,500, and beyond this 10 lakh rupees at the rate of 30%. Okay. So 1 lakh 12,500 plus 30% of the amount by which total income exceeds rupees 10. This slab is for individual HUF. They can be resident, non-resident. They can be male, female. AOP, BOI, artificial, juridical person. For resident senior citizen and for resident super senior citizen, some extra tax concession has been provided. So the second slab that we are studying is for senior citizen. Senior citizen means a person who is a resident in India in the previous year of the age of 60 years or more at any time during the previous year, but less than 80 years, because for 80 years and above person there is a much more beneficial slab. Okay. So thus the second slab is for senior citizen resident individual of 60 years or more but less than 80 years at any time during the previous year. For first 3 lakh rupees, no tax. 3 lakh to 5 lakh, 5%. 5 lakh to 10 lakh, since already 3 to 5 has gone, means 2 lakh rupees. 5% means 10,000 already came. 10,000 plus 20%, and above 10 lakh rupees, since 10 lakh has already crossed, 10,000 plus 1 lakh, 1 lakh 10,000 plus 30%. Then sir, how much benefit a senior citizen got? From 1 lakh 12,500 to 1 lakh 10,000, means 2,500 rupee benefit of a senior citizen got. If a person is a super senior citizen, means a resident individual of the age of 80 years or more at any time during the previous year, then for the first 5 lakh rupee nil tax. My recommendation will be to the government that give complete tax exemption to all those people who are of 80 years or more in India, because there is a very few people nowadays in India who can survive such long, and if we give complete tax exemption, it will be a great gratitude to them from the government. Okay. Where the total income does not exceed 5 lakh rupee nil, from 5 lakh to 10 lakh rupees 20%, and from 10 lakh rupees 1 lakh plus 30%. So if you are super senior citizen, then how much tax benefit you are getting over a senior citizen? Rupees 10,000. Okay. Again, these are two tax slabs are only for resident individuals. So if you are a non-resident, even if you are of the age of 60 years or 80 years, you cannot claim these beneficial slabs, and you will be governed by the first slab. I hope you have got the point. Okay, now a prominent issue, not so prominent, because nowadays the main regime is the default tax regime, but still. Sir, to claim the benefit of beneficial tax slabs, the remaining two slabs that we have discussed. A person should be of the age of 60 years or 80 years at any time during the previous year. Our previous year is previous year 25-26. Any time during the previous year means 1/4/2025 to 31st/3/2026. Means if a person attains the age of 60 years or 80 years, in between this period he can claim the benefit of higher tax slab. Are you guys getting? Okay. Now a important issue arises: how we will measure the age. Sir, what you want to say? Just for example, if let's say my date of birth is 1st April 2001, then when I will say that I have completed 1 year, on 1st April 2002 or 31st March 2002. When I will say that I have completed 1 year on 1st April 2002 or 31st March 2002. Because in India there are various acts, and in different acts, some act consider this, some act consider this. Then what is going to be for income tax purposes? Supreme Court in its judgment and CBDT through a circular has said that we will adopt this approach. This approach. So if a person has taken birth on 1st April, for income tax purposes, we will consider that he has achieved a particular age on 31st March itself, means a date before his birthday, a day before his birthday. Technically, it may not sound true, but for income tax purposes, we are adopting this approach. So, if a person has taken birth, let's say on 1/4 1966, if a person has taken birth, let's say on 1/4 1966, to claim the benefit of higher slab rate, he has to be of 60 years at any time between 1/4 2025 to 31st 3 2026. Are you guys getting? But as he has taken birth on 1/4 1966, he will be of 60 years on 1/4 2026, which do not fall in previous year 2025-26. Are you guys getting? But as per the Supreme Court judgment, what we will say, that that person has achieved the 60 years age in 31st March 2026 itself. Hence, the person who has taken birth on 1st April 1966 is also eligible for higher slab rate of 3 lakh in previous year 2025-26. Are you guys getting? Sir, what if I have taken birth prior to 1/4 1966? Then there is no issue. You will very easily qualify for the higher tax slab. Sir, what happen if I have taken birth after 1/4 1966? Then there is nobody who is going to help you. You have to wait a bit more for higher tax slab. Okay. We have seen all this. Okay. Now we are moving forward. Rebate to resident individuals, as we was talking about. We were talking about, sir, up to rupees 12 lakh income there was no tax, as we have read in the news. But you are saying that only 4 lakh rupees there is no tax. Then how this is going to work? Dear friends, there is rebate under section 87A, and the rebate is provided in two regimes. One is default regime and one is optional regime. So first talk about optional regime. In optional regime, if your total income is up to rupees 5 lakh, then you will get a rebate of 12,500 or a tax whichever is lower. It effectively makes you not to pay any tax if you have income up to rupees 5 lakh in a financial year. Although if you recall, the slab for the optional regime is only first 2,50,000, means up to rupees 2,50,000 there is no tax. But because of 87A rebate, what has happened, that effectively up to rupees 5 lakh you don't have to pay a tax. Okay. As far as the default regime is concerned, what government wanted, that up to rupees 12 lakh per year income there should not be any tax. Then government said, okay, if your income is up to rupees 12 lakh per annum, then we will provide you a rebate of rupees 60,000 or tax whichever is lower. So why 60,000? Because as per the default regime tax slab, the income tax on rupees 12 lakh income will be 60,000. 0 to 4 nil, 4 to 8 20,000, and 8 to 12 at the rate 10% 40,000. Then the tax will be 60,000. So the government has said, okay, if your income is up to rupees 12 lakh per annum, we will give you a rebate of rupees 60,000. So effectively, you are not required to pay a tax. Okay. Rebate to resident individuals. Resident individuals. So this is very important to understand that only resident individuals are eligible for 87A rebate. If you are a non-resident individual, you are not eligible. If you are a resident HUF, you are not eligible. Okay. Only resident individual having a total income of up to rupees 5 lakh is eligible for rebate, and amount of rebate is 12,500 or 100% of tax payable, whichever is low. What about default regime? If your income is up to rupees 12 lakh, then you will get 100% of the tax payable, or rupees 60,000, whichever is low. Okay. Sir, what if my income in the default regime is a 12 lakh 5,000? What if my income in the default regime is 12 lakh 5,000? As my income has exceeded 12 lakh rupees, am I not eligible for any kind of rebate? The government said, okay, we will do something for you. Okay, if your income is slightly higher than rupees 12 lakh, even then you will get a rebate. Then how much rebate you will get? Okay. How much income, how much more income you have earned over rupees 12 lakh? Sir, 5,000 rupees only. Okay, so pay this as a tax. Pay this as a tax, except 5,000 rupees. All other tax portion will you will get as a rebate, sir. Means okay. Tax on 12 lakh 5,000. How much is the tax? So 60,000 rupees for first 12 lakh, and for the next 5,000 rupees at the rate 15%, it is 750. So the tax amount is 6,750. Means I have to pay 6,750 because my income is 12 lakh 5,000. If my income was 12 lakh, I have to pay nil. It means just because this 5,000 rupees I was required to pay 6,750. Okay, government said okay, we will provide you a rebate. And but how much rebate? Not entire 6,750, because you have earned 5,000 over rupees 12 lakh. So we will provide you rebate of 55,750. So effectively you will have to pay us tax of 5,000. Means whatever you have earned over and above rupees 12 lakh, pay this as a tax and accept this entire as your rebate. Okay, rebate if the amount exceeds rupees 12 lakh, tax payable on the total income. In our example, the tax payable on total income of 12 lakh 5,000 was 6,750. In less amount by which total income exceeds 12 lakh, how much was my total income? 12 lakh 5,000. By how much amount my total income is exceeding 12 lakhs at 5,000 rupees? How much is the rebate amount? 55,700. So this is the amount of rebate. Then sir, why not entire 6,750? Dear friends, even government needs some money as a tax to run the country. Then if it won't get, then how you will the government will function? So this is the amount of rebate that you get. Okay. Very important point for rebate. Difference. 87A rebate is not available on lottery income. So if you have earned anything as lottery income, you won't get rebate on that lottery. Okay. This is very important point. The first point is very important. There might be some disputes in this point, and you may not fully agree with this point, but I can't help you. Even I may have some observation or some reservation. But this is the line which has been taken by ICI, so we have to read it as it is. Okay. A rebate under section 87A is not available on if assessee paying tax under default tax regime. Rebate under section 87A is not available in respect of tax payable on LTCG under section 112, 112A or short-term cap gain under section 111A. Means if assessee have any income which is taxable under section 112, 112A or 111A as a short-term cap gain, on that income 87A is rebate. 87A rebate is not available if the assessee is in default regime. But if the assessee is in optional regime, that rebate is available on 112 and 111A but not on 112A. However, in case assessee opt-outs of the default tax regime, rebate under section 87A is available in respect of 112A, 112 LTCG, 111A short-term cap gain, but not against 112A LTCG. Sir, this is very confusing. Dear friends, just remember, in the default tax regime, rebate under section 87A is not applicable on 112, 112A and 111A. In the optional tax regime, rebate under section 87A is not available on 112A but available on 111A and 112. Okay. Proceeding further, surcharge and marginal relief. Okay. How much surcharge that you have to pay if your total income is not exceeding 50 lakh? Means if your total income is up to rupees 50 lakh, then there is no surcharge. If your total income exceeds rupees 50 lakh but up to rupees 1 crore, then surcharge is of 10% on that on the income tax, means whatever is the tax, add a 10% of tax as surcharge. If your total income exceeds 1 crore and up to rupees 2 crore, then the rate of surcharge is 15% of the income tax. If your total income exceeds rupees 2 crore, here there is a reason. If your total income exceeds rupees 2 crore, then the earlier provision was if your total income exceeds 2 crore to 5 crore, 5 crore to beyond. So if the total income exceeds 2 crore to 5 crore, the rate of surcharge will be 25%. If the total income is 5 crore to beyond, the rate of surcharge will be 37%. So 37% rate of surcharge. Yes. Okay, there was a huge demand in India to impose super rich tax. Super rich tax means tax more, means more tax on super rich people. Considering that demand, government has introduced surcharge rate as high as 37%. So if your total income exceeds rupees 5 crore, you have to pay the surcharge at the rate of 37%. Okay. But now this 37% surcharge is not applicable in default regime. In default regime, this surcharge of 37% is not applicable. Means if you are in the default regime, even if your income exceeds 5 crore rupees, the maximum surcharge will be applicable on you will be 25%. So sir, then for whom this 37% surcharge applicable? Only for the people who are in the optional regime. Then sir, why anybody will be in the optional regime? You guys are right. Is most of the people, almost 95% of the people have already migrated to the default regime. Why will anybody be in the optional regime when he has to pay a surcharge as high as 37%? Okay, that's one point. Another very important point. If your income exceeds rupees 2 crore to 5 crore, then there is a surcharge of 25%. Dear friends, when this provision has been introduced, I remember this was introduced in 2019. Before 2029, before 2019, basically, long-term cap gain on sale of equity was exempt under Section 10. Sir, yes, sir. LTCG on equity was exempt. Means no LTCG you have to pay. Okay. To tax LTCG, government has brought 112 at the rate of 10% at that time, which was increased to 12.5%. So government has withdrawn LTCG. Government has withdrawn LTCG. There is a huge uproar in the market. You have withdrawn LTCG as well as you have imposed surcharge of 37%. So there is a huge uproar in the market. To calm down the market, government has said, okay, we will tax your dividend income, 111A short-term cap gain, 112 long-term cap gain, and 112A long-term cap gain. These were introduced in the years to come, but today this is the position. In all these income, the rate of surcharge will be 15% of the tax payable irrespective of your income. Means irrespective of your income means even if your income is 100 crore rupees. So if your income exceeds rupees 2 crore, out of those income, for these four components of income, the maximum rate of surcharge you have to pay is 15%. Okay, so out of your total income, these four income will be taxed. There will be surcharged at the rate of 15%, and for other income, you may have to pay surcharge of 25%, and in the default optional regime, you have to pay it for at the rate of 37%. But for these four components of income, the maximum rate of surcharge will be 15%. Okay, so read this quickly. On the tax computed on cap gain under section 111A, 112, 112A and dividend income, surcharge is capped to 15%. On tax computed on total income after reducing these four income, if such income is up to rupees 2 crore, then 15%. If such income is beyond rupees 2 crore but up to 5 crore, then sir, why 5 crore? You have said in the default regime there is no condition of 5 crore. Yes, you are right. If the income is above 2 crore or above 5 crore, in the default regime 25%, in the optional regime it is above 2 crore to 5 crore 25%, but above 5 crore 37%. above 5 crore 37%. I hope you guys got the point. But there is one more aspect. If you are AOP, if you are AOP consisting only companies as its members. So if you are AOP whose members are only companies. Dear friends, remember, if a AOP has only companies as its members, then the AOP is subject to tax at the rate of maximum marginal rate, which is already very high. So if a entity is already taxable at the rate MMR, is it rational to impose a surcharge of 37% on that entity? No, sir. So we have said, okay, for a AOP consisting only companies as its members, the surcharge is payable at the rate of 15% cap, means not beyond 15%, no 25%, no 37%. Okay. For such companies, if the total income is up to 50 lakh, no surcharge. 50 lakh to 1 crore, 10%. Above 1 crore, irrespective of the higher limit, 15%. Means we will not see it is above 1 crore to 2 crore, 2 crore to 5 crore, etc. But sir, what about what if this AOP has any LTCG of 111A, 112, 112A? It does not matter. Why? Because the maximum surcharge rate is 15%. So even if this AOP has any LTCG or any dividend income, there is no issue because the maximum surcharge rate is how much? 15%. This issue will arise if the rate of surcharge applicable is more than 25, more than 15% on any entity. But as the maximum surcharge applicable on AOP is itself 15%, there is no issue. Okay. These are the examples that you should try. You will get the clarity. Okay. Another important aspect is marginal relief. Dear friends, if you look closely, surcharge is applicable on when? When? If my total income is from 0 to 50 lakh, no surcharge. My income crosses 50 lakh, I have to pay 10% of total tax. Total tax as a surcharge. Okay. If my income crosses, this is 100 lakh rupees, 100 lakh rupees, my surcharge rate increases from 10% to 15%. If my income crosses from 200 lakh to infinite in case of default regime, 500 lakh in case of optional regime, I have to pay surcharge of 25%. If my income exceeds to infinite from 500 lakh, in the default regime, my surcharge rate will be 25%, but in the optional regime, my surcharge rate will increase to 37%. What this 37% means? Sir, this 37% means that from the income, from this level of income, means the tax from this level of income, the entire tax will further be increased by 37%. This entire tax will further be increased by 37%. So there may be some situation. What kind of situation? Let's say if my income is 50 lakh rupees, my tax liability is let's say 5 lakh rupees, or let's say 10 lakh rupees. 10 lakh. As my income has increased to 50 lakh, 51 lakh, 51 lakh rupees, my tax may increase to 12 lakh rupees. Fine. If my income was 50 lakh rupees, the tax liability applicable on me was 10 lakh rupees. But as my income has increased from 50 lakh to 51 lakh rupees, my tax liability got increased to 12 lakh rupees. Means the increase in my income is only 1 lakh rupees, but the increase in my tax because of this increase in income of 1 lakh. Dear, very, very careful. Because of the increase in income of 1 lakh, how much my tax liability increased? By 2 lakh rupees. Sir, how it is possible? It is very much possible. Because of a concept, because of a tax which is known as surcharge. Because of surcharge. At the rate of 10% increase. Because the surcharge is applicable from the income, from the tax on income starting from 1 rupee. And as surcharge is applicable from very beginning, it is very likely that the cumulative effect surcharge may cause the income tax to increase by an amount higher than the increase in income which has triggered that surcharge. Okay, I will not say more on this. Then, sir, what do you want to see? This is revision video. Okay. So there is a concept called marginal relief. What marginal relief says? Okay, what marginal relief says? Before this, understand when marginal relief comes into play. Marginal relief will come into play. Marginal relief will come into play when increase in tax due to surcharge is more than increase in income which triggered that surcharge. Marginal relief will come to play when increase in tax due to surcharge is more than the income which has triggered the surcharge or which has caused the increase in surcharge. So the same example we can apply in case your income is, let's say, 100 lakh rupees, 10% surcharge, but your income increases to 101 lakh rupees, the total rate of surcharge increases to 15%. There again the marginal relief concept will may come into play. Are you guys getting? Okay, so we have understood when marginal relief comes into play when there is an increase in when the increase in tax due to surcharge is more than the increase in income which has caused the levy of surcharge or which has caused the increase in the rate of surcharge. Then what marginal relief will do? Marginal relief will ensure that the increase in tax due to surcharge should not be more than the increase in income which has either caused the levy of surcharge or triggered the increase in surcharge. Sir, what you want to say? Okay, like for example, let's say I am in the default rate. My income is 50 lakh rupees, calculate the tax. Sir, for 50 lakh rupees, first 24 lakh, 3 lakh rupees. So 26 lakh into 0.3 plus 3 lakh, the income tax will be 10 lakh 80,000 before health and education cess. Let's say my income is 51 lakh. Now how much is my tax liability? Sir, 27 lakh into 0.3 plus 3 lakh. Sir, 11 lakh 10,000. No, this is 11 lakh 10,000 before surcharge. Add a surcharge plus 10% means 10% means 12 lakh 21. Now you can see that the increase in income is 1 lakh, but how much increase in my tax liability because of the increase in income of 1 lakh? Sir, 1 lakh 41,000. How much is the increase in income by 1 lakh? How much is the increase in surcharge due to this increase in income? Sir, how much is the increase in tax due to the increase in income? Because this increase in income has triggered a surcharge on the entire income. So the cumulative effect of that surcharge is 1,41,000 while the increase in income is just 1 lakh rupees. So does it make any economic sense where I am getting 1 lakh rupee increment from my company, but the tax department is taking 1,41,000 from me because I am getting 1 lakh? If this will be the case, what I am going to say to my employer? Sanji, मुझे इंक्रीमेंट नहीं चाहिए. I don't want your increment because आप तो मुझे 1 लाख का इंक्रीमेंट दोगे. You will give me the increment of 1 lakh. But the department will take this entire money. Not only this, again, it will also take 41,000 rupees from my pocket. Then what is the relevance of this increment for me? Are you guys getting it? So the department says, okay, we guys are not so bad. We will give you a relief of how much? 41,000. We will give you a relief of 41,000 rupees. So we will ensure that the increase in your tax liability, very important. The increase in your tax liability due to the increase in income which caused the surcharge or increase in surcharge, the increase in tax should not be more than the increase in income. If the increase in tax is more than the increase in income, here what happened? Increase in tax is more than increase in income. The increased portion of tax will be available as marginal relief. How much is the increase in tax? 1,41,000. How much is the increase in income? 1 lakh. By how much the increase in tax is higher than increase in income? 41,000. Take it as a marginal relief. So what is the formula for marginal relief? Increase in tax minus increase in income. The balance amount will be marginal relief. I hope you have got it. Okay. So this is the theory. If you want to read the theory, you can. Okay. Okay, now we have already taken a lot of time. Now very quickly, tax rate and surcharge rate for other persons. We have already seen the tax rate and surcharge rate for individual, HUL, AOP, POI, and artificial juridical person. Now it is the time for other persons. If the assessee is a firm, LLP, or local authority, if the assessee is a firm, LLP, or local authority, there is a flat 30% tax on the whole income. When I say whole income, it does not include those income which are taxable at a special rate. Those special income will again be taxed at the special rates. So this whole income basically means other than special income. Okay. Surcharge 12% of the income tax if total income exceeds 1 crore. So if the total income exceeds 1 crore, 12% rate of surcharge will apply, and yes, the marginal relief will be applicable as we have discussed. Okay. What about cooperative society? Dear friends, if the total income of cooperative society is up to rupees 10,000, 10% of the total income, 10,000 to 20,000, 1,000 plus 20%, or exceeds rupees 20,000, then 3,000 plus 30%. Surcharge rate, dear friends, the surcharge rate for cooperative society and domestic company are same. So if the total income is up to 1 crore, no surcharge. 1 crore to 10 crore, 7% surcharge. More than 10 crore, 12% surcharge. Dear friends, there are two alternate taxation regime applicable for the cooperative society. Although one of the regime is now not not available anymore, 115 BAE. Anyhow, so there are two alternate regimes for cooperative society. One is 115 BAE, which now no more can be adopted by a new cooperative society, and one is 115 BAD. In these two alternate regimes, there is a compulsory surcharge of 10%. So 115 BAE regime has a rate of tax 15%. 115 BAD tax rate is 22% plus 10% compulsory surcharge plus 10% compulsory surcharge. Okay. What about domestic company? If the turnover or gross receipt in the previous year of the domestic company in the previous year 2023-24 is up to rupees 400 crore, then the tax rate is 25%, otherwise 30%. So we have to see the turnover or gross receipt of the domestic company in the previous year 2023-24. Sir, what if the company was not present in 2023-24? Means it has been incorporated after 2023-24. Then, dear friends, as per CVDT FAQ, a domestic company which was not in existence during the relevant previous year 2023-24 and incorporated after that shall be regarded as having nil turnover for that year. So if we have nil turnover, then the rate of tax will be 25%. Okay, surcharge rate is same as of cooperative society. Dear friends, for domestic company there are two ATRs. One is 115 BAA and another is 115 BAB. Although 115 BAB is now cannot be adopted by a new company because the time limit has already been expired, but still there are two alternate regimes. Here the tax rate is 22%, here the tax rate is 15% plus 10% compulsory surcharge plus 10% compulsory surcharge. As the surcharge is compulsory, there is no marginal relief. As the surcharge is compulsory, there is no marginal relief. Okay. What about foreign company? Foreign company flat 35% of the total income. Again, I am saying total income means those income other than the income for which the special rate has been provided. Okay. What about surcharge rate up to 1 crore? No surcharge. 1 crore to 10 crore, 2% of total income. And if the total income exceeds 10 crore, 5% of the total income. Marginal relief will be applicable as per the normal provisions. This was surcharge. And any income tax plus surcharge shall further be increased by an additional surcharge known as health and education cess at the rate of 4%. Okay, you know that if the total income is not in the multiples of 10, it should be converted into the multiples of 10. In the same way, if the tax liability is not in the multiples of 10, it will be converted into in the multiples of 10. And how this conversion happens? Let's say my total income or tax liability is 1,41,086 paise. Although now paisa etc. is irrelevant. But if this is the case, then first paisa will be ignored. We will remove the paisa, we will cut the paisa, and the last digit will be seen. The last digit here is 1. If the last digit is less than 5, then it will be reduced to lower multiple. So the rounded off figure will be 420. So this will be my total income or tax liability. If let's say it is 100,427.96, then again paisa will be eliminated, and as the last figure is 5 or higher, it will be rounded off to the higher multiple. My rounded off for tax or income tax will be 100,430. Okay. Last figure is 5 or more, it shall be increased to the next higher multiple of 10. Okay. Diversion of income by overriding title and application of income. Dear friends, it is a significant concept. There are two things. One is application of income. One is application of income. Another is diversion of income. Diversion of income. Diversion of income. What application of income means? Let's say I have got a salary of rupees 1 lakh. I have got the salary of rupees 1 lakh, and out of that salary, I have purchased a phone for rupees 30,000. So I have applied this income. I have applied this. So this is the application of income. Once income arises to me, once any income occurs or arises to me, how I am applying that money does not affect my income tax liability. Does not affect my income tax liability. Let's say I have got a salary of rupees 1 lakh. Let's say I have got the salary of rupees 1 lakh, and I have paid the EMI of my car of rupees 20,000. Again, this is what application of income, because I have earned the salary of rupees 1 lakh. The salary of rupees 1 lakh has arises to me. Now it is my call how I am going to apply or how I am going to use that money. Irrespective of the method I am using that money, it is not going to affect my tax liability. Are you guys getting? Are you guys getting? Okay. Now a two-step case. I have to pay the EMI of rupees, let's say 20,000 of my car, of my house. What I say to my employer? Sir employer, Mr. A is the employee. What Mr. A says to his employer: sir, give me a check of rupees 80,000 and give me a check to my bank of rupees 20,000. Employer, you are required to pay me salary of rupees 1 lakh. Employer say yes. How you pay me the salary? Employer say, I will give you a check of rupees 1 lakh. I, as an employee, say to my employer, sir, don't give me a check of rupees 1 lakh in my name. Give me a check of rupees 80,000 in my name and issue a check to the bank to whom I have to pay the EMI of rupees 20,000. You issue a check to the bank of rupees 20,000. Okay. Now, can I say that? Can the employee now say that he has actually earned rupees 80,000 as a salary because 20,000 rupees has been paid by the employer to the bank, which employee has not received? No, sir. Dear friends, please understand. Here what happened? Here employee has diverted. This income of rupees 20,000 from employer, means from source. Employer is what? Source. The income has been diverted. Instead of this income going to employee, this income is going to the bank to pay the liability of employee. So the income got diverted from source. But now what we have to check? Income has been diverted. There is no issue. Income has been diverted. But is this diversion is under any legal or contractual obligation of employer and bank? Why employer has diverted this 20,000 rupees to bank instead of Mr. A? Was employer under some legal or contractual obligation with the bank to divert this 20,000 to the bank instead of Mr. A? Answer is no. Then why employer has diverted this money? Because Mr. A has requested the employer. Was employer under some legal or contractual obligation to divert this 20,000 instead of Mr. A to the bank? Answer is no. And if the employer was not under some legal or contractual obligation to divert this 20,000 rupees to the bank, Instead of Mr. A, this is diversion. Okay, this is diversion, but this diversion is not by overriding title. This diversion is not by overriding title. And hence, and as this diversion is not by overriding title, this diverted income from the employer to the bank is going to be taxable in the end of Mr. Are you guys getting? Are you guys getting? Okay, sir. Another example. Another example. There is a partnership firm, or let's say there is a business. There is a business run by Mr. Mr. B approached Mr. A and said, Mr. A, you are now of a very old age. Transfer this business to me. I will run this business. I will run this business. Mr. A says, okay, I am ready to sell or transfer my business to you. I am ready to sell or transfer my business to you, subject to the condition that you have to pay rupees 30,000 per month. You have to pay rupees 30,000 per month to, let's say, my wife, Mrs. You have to pay 30,000 per month to my wife, Mrs. Dear friends, please. Mr. B have understood this condition, and there was an agreement with Mr. A and Mr. B, where Mr. B has have agreed to the condition that he is going to pay 30,000 rupees per month to the wife of Mr. Now, let's say, now this 30,000 rupees which is being paid by Mr. B to the wife of Mrs. A, is it application of income or a diversion by overriding title? Sir, why Mr. B is paying this money to Mrs. A? Out of some legal or contractual obligation? Answer is yes. Why Mr. B is paying the money to the wife of Mrs. A? Because Mr. B has entered into a contractual obligation with Mr. A. That's why he is paying this amount to Mrs. A. If Mr. B will not pay this amount, then he is breaching the contract and there can be legal consequences against him. So this is the case of diversion of income by overriding title. And in case of diversion of income by overriding title, this amount can be claimed by Mr. B as a business expenditure. I hope you have got it. Okay. So I have give all you these examples. Now, before concluding the revision, some basic concepts of salary income and house property income. Different salary income, you know, three kinds of deduction is available for salary income, which is relevant for CA final level. You are not required to remember those house rent, HRA type of things. These are for CA inter. Okay. There are three kind of deductions, and this is the general format of salary income: salary, bonus, commission, etc., travel allowance, perquisites, value of perquisites, gross salary, and then from this gross salary there are three kinds of deduction. One is standard deduction, another is entertainment allowance deduction to government employees, and another is professional tax deduction. Okay. Now, if the employee is in default regime, then standard deduction allowed up to rupees 75,000. Entertainment allowance deduction not allowed, professional tax deduction not allowed. If employee is an optional regime, standard deduction allowed up to 50,000. Entertainment allowance deduction allowed to the government employee, and professional tax deduction allowed to all employees if he has paid them. Okay. How much is the entertainment allowance deduction? 1/5 of the salary, 5,000 rupees, or entertainment allowance actually received. You are not required to remember these limits, but anyhow. And what about professional tax? Professional tax actually paid by the employee during the previous year is allowed as a deduction. Okay. But if the employer has paid the professional tax, let's say the professional tax of the employee has been paid by the employer, then first this amount will be included in the salary income of the employee. And if the employee is in the optional regime, then 2,500 will be allowed as a deduction under section 16. So first the amount will be included, then the deduction will be allowed, so the impact will be nil. Now moving to the house property here. Okay. Here the important aspects that we have to see is that determination of annual value. This is a bit different. House property is probably only head of income which talks about to tax the notional rent instead of the actual rent. But sir, notional income is taxable in other heads also. Like if you see cap gain under section 50C, this is what? If your full value of consideration is less than the fair market value, then we will tax the notional income. The same applies with 43 CA. So there are other provisions also which tax the notional income instead of the actual income. I agree. But house property is the only head which talks about, or the foundation of which lies on to tax the notional income instead of the actual income. So if you have understood this point, this is okay. If you have not understood, no issue. Okay. House property head, how we are going to tax or how we are going to calculate the gross annual value. We will compare something. We will compare few things. One is the municipal value, where we will take the higher. Then we will compare this higher with the standard rent. We will take the lower. This lower is called expected rent. Now this expected rent will be compared with the actual rent, and whichever is higher will be taken as GAV. It means if we are going to determine the income from house property of any associate, we are not simply considering what the associate is saying. First, we will see the municipal value of the property, and the fair rent of the property means the rent of the similar kind of property. Higher will be taken. This higher will be compared with the standard rent, which is fixed by the Rent Control Act. The lower will be taken, and this lower will be known as expected rent, and this expected rent will now be compared with the actual rent which employee says, or which the associate says that I have earned, and out of the higher will be the GAV. Okay, so this is how we are calculating the GAV. So computation of GAV, higher of expected rent and actual rent received receivable. Expected rent was what? Higher of municipal value and fair rent, but restricted to standard rent. Actual rent received receivable, reducing the unrealized rent. Unrealized rent is the rent which the tenant has not paid. Okay. So this is the GAV. Out of this GAV, we will reduce the municipal taxes which has been paid by the owner, means actually paid by the owner, not on the accrual basis, the actual payment during the previous year. This will be known as NAV, net annual value. And out of this net annual value, there will be 30% of standard deduction of NAV and interest on borrowed capital. And if you have borrowed some amount to build the property, to upgrade the property, to repair the property, you will get the interest. Apart from these two, there is nothing which is allowed as deduction. One very important aspect is that you will get the deduction of just 30% of NAV as a standard deduction. Sir, what about depreciation of the property? Won't I get the expenditure for depreciation? Won't I get the expenditure for insurance? I have insurance premium paid. Will not get I deduct the deduction for repair and maintenance, etc. Nothing. You will get anything. What about, sir, the water tax I have paid? What about the ground rent I have paid? Means only these things. 30% of flat deduction you will get, and interest deduction. So house property head is considered as a harsh head for many associates. So many associates try to divert their income from house property head to PGVP. Because in PGVP head you will get the deduction for depreciation, you will get the deduction for insurance, repair and maintenance, and there are also few fake things you can include and you can get the deduction. But nothing is allowed under house property head. This is important to understand. Okay. What about interest on loan taken? Dear friends, there are two regimes. You know there are two regimes. One is the default regime, one is the optional regime. In default regime, if the house property is self-occupied, no interest on loan allowed as deduction. If the house property is let out, deemed to let out, then 100% interest deduction allowed without any ceiling limit. In the optional regime, if the house property is self-occupied, if the house property is let out, deemed to let out, the house property is let out or deemed to let out, there is no issue. You will get 100% interest deduction. But if the house property is self-occupied, then how much interest deduction is allowed? Interest on borrowed capital. If you have taken the loan for repair, renewal or reconstruction of the house property, then maximum 30,000 rupees. You have taken loan for purchase or construction of house property and the purchase or construction has been completed within 5 years from the end of the financial year in which the money was borrowed, and you have obtained a certificate from the lender and furnished it to the department, then you will get the interest deduction of 2 lakh rupees, otherwise 30,000 rupees. Sir, what if I have taken a loan for repair and reconstruction and a loan for purchase? Then will I get the deduction of 2 lakh plus 30,000? Answer is no. You will get the cumulative deduction of maximum 2 lakh rupees. Sir, what about the property held as stock in trade? If the property is held as a stock in trade, like for example, a real estate company. For real estate company, the property is basically what? Stock in trade. So it is expected from them to sell the property, or if they are not selling the property, give it on rent. They should not keep the property as it is or unoccupied, because it causes the artificial shortage of property of real estate in the market, which artificially increases their prices. So what the law says, if the house property is being held as a stock in trade by the associate, then for the first 2 years it is okay. For the first 2 years from the end of the financial year in which the completion certificate is issued, it is okay, you can keep it as unoccupied. But beyond 2 years, either let it out, sell it, or if you are not selling it, if you are not actually letting it out, we will treat it as deemed to let out, and we will tax the notional income as a rent and under that house property, and we will tax the income as a house property income. Okay. In some cases, property consisting of any building or land thereto may be held as a stock in trade, and the whole or part of the property may not be let out during the year. In such case, the annual value of such property will be taken as nil. However, this benefit will be available for a period of 2 years from the end of the financial year in which completion certificate is issued from the competent authority. So for the first 2 years, if you have not actually let out the property, it is okay. But after 2 years, if either actually let the property out, if you are not doing it, we will deem it as a let out and we will tax it as a we will tax the notional income. Okay. Taxability of arrears of rent and unrealized rent. Dear friends, this point is many times asked in the MCQ form. Many times happens what? That we receive the unrealized rent. We receive the unrealized rent or arrears of rent. Unrealized rent of past years or rent in arrears of past year we will receive in the current year. In such case, whatever amount we are receiving, 30% of it will be allowed as deduction. Apart from 30%, no further deduction will be allowed, and that income is taxable in the year in which you have recovered the unrealized rent or arrears rent, whether or not you have owned the property. Let's say Mr. A has a property which he has let out to Mr. B in the year 2020. Mr. B has not paid the rent and the rent amount was 5 lakh. In the year 2026, Mr. A has recovered that rent from Mr. B, but he has already sold the property in the year 2022. No issue. You have recovered the rent? Yes, sir. 5 lakh rupees? Yes, sir. Out of 5 lakh, 30,000 will be allowed as notional deduction and 3 lakh 50,000 will be taxable in the previous year 2026. Are you guys getting? Under that house property. But sir, now I am not owing the property. No issue. Whether or not you are owing the property in the current year, it is immaterial. If you have recovered any arrears of rent or any unrealized rent of past year, it is taxable in the year in which you have recovered it after providing 30% notional deduction. The amount of rent received in arrears from a tenant or the amount of unrealized rent realized subsequently from a tenant of by an associate shall be deemed to be the income of the house property in the financial year in which such rent is received or realized, and shall be included in the total income of associate under that house property, whether the associate is the owner of the property or not in that financial year. However, a deduction of 30% of arrears or rent will be provided. Okay, so this point is important from the MCQ point of view. Okay. What if house property is owned by co-owners? If the house property is owned by more than one person, then all those persons will be allowed the interest deduction of 2 lakh rupees or 30,000 rupees separately for self-occupied property if they are in the optional regime. So let's say Mr. A and Mr. B are brothers and they have a house in which both have 50-50% share, and they have taken a loan for the purchase or construction of the property, and the house property is self-occupied by them. If they are in the optional regime, then they both will be allowed to 2 lakh rupees of deduction, up to rupees to 2 lakh deduction for interest on loan for the house property. But again, if they are in the default regime, then there is no reduction. Sir, what if Mr. A has one property which is co-owned and one property which is fully owned by Mr. A? Will he get 2 lakh rupee further deduction? No, the cumulative interest expenditure of only 2 lakh rupees allowed. So, or if the property, if the loan has been taken for repair or reconstruction, then 30,000. Okay. The aggregate deduction of interest to each co-owner in respect of interest payable cannot exceed 30,000 or 2 lakh as the case may be. Okay. There are certain provisions which are for the deemed ownership of the property. Means even if the property may not be registered in the name of assessee, but the assessee will be considered as a deemed owner of the property and income will be taxable under the head house property. So what are the situations? Transfer of house property to spouse otherwise than for adequate consideration or in connection with an agreement to live apart means a divorce. So let's say Mr. A has transferred his house property to his wife Mrs. A, not for adequate consideration or in the divorce case. In such case, Mr. A will be continued to be treated as the owner of the house property for income tax purposes. Means Mr. A will be treated as a deemed owner of the property. I hope you get the point. Okay. Transfer of house property to minor child except a minor married daughter. If you are transferring the house property to minor married daughter, the clubbing provisions will apply, but it will not be considered as a deemed owner. But if you are transferring the house property to the minor children except a minor married daughter, then clubbing provisions won't apply, but you will be considered as a deemed owner of the property, and by considering you as a deemed owner, the income under the head house property will be calculated as per the provisions and the income will be taxable in your head. Okay. Holder of impartable estate deemed to be the individual owner of all properties combined in the estate. Dear friends, sometimes the estate, the property are legally indivisible. In such case, whoever is considered as the owner of that property as per law or under some contract will be considered as a deemed owner of all those properties which are comprised in the undividable estate. Okay. Many times, let's say if you have become the member of a cooperative housing society and the cooperative housing society allotted you a flat to live, although the legal owner of the flat is the cooperative society, but since you have been given the right to use the property, you will be treated as the deemed owner of that property for tax purposes. A member of the cooperative society, company or EOP to whom a building is allotted or leased under a house building scheme shall be deemed to be the owner of that building allotted to him, although the cooperative society, company or EOP is the legal owner of that building. Okay. A person who is allowed to take or retain the possession of any property in the part performance of the contract. Let's say Mr. A have some house. He has given this house to Mr. B to live. Means Mr. A has given the physical possession of house to Mr. B. Dear friends, will any sane person will give the possession, the physical possession of his immovable property to another person without the full payment? No, sir. But if you have given the possession of your immovable property to another person, although the property may not get registered in the name of Mr. B, it is immaterial. We will treat Mr. B as a deemed owner of it. Okay. A person who acquires any right in the property by lease for not less than 12 years shall be deemed to be the owner of that building or part. Means if you have given your property on lease to another person for a period of not less than 12 years, then the lessee will be treated as the deemed owner of that property. Sir, why this provision came? Okay, I won't take much of your time. Happens what, dear? Let's say Mr. A has a property. Mr. A has a property. He has given this property on lease to Mr. B, who is a brother of Mr. A. He has given this property on lease to Mr. B. For Mr. A, the income will be taxable under the head house property. For Mr. A, the income will be taxable under the house property because he has given the property on lease. Mr. B has subleased the property to some industrial undertaking. on a very high rate, on a very high rate. Now, for Mr. B, this property is sublet. Sublet property income is taxable under the head income from other sources. And if the income is taxable under the head income from other sources, then Mr. B can claim higher deduction compared to house property, which says only 30% flat notional deduction. Are you guys getting? So what used to happen is that people used to transfer their immovable property to their relatives under lease, under long-term lease, 20-year lease, 30-year lease, 50-year lease, 10-year lease. And relative used to further let the property out as a lessee, means sublease, so that the lease income, the rental income which is paid by the industrial undertaking to the brother of Mr. A, means Mr. B, now it will be taxable under that income from other source. So Mr. B will get the higher deduction compared to the income under the house property. To curb this practice, what the law says, if a person who acquires any right in any property by the way of lease for not less than 12 years. So let's say Mr. A has given this property on lease to his brother Mr. B for, and the lease period is of, let's say, 20 years. Then in this case, Mr. B will not be treated as a tenant for income tax purposes. He will be considered as a deemed owner of that property, and now the rental income which is being paid by the industrial unit to Mr. B will taxable under the head house property, not income from the sources in the hands of Mr. B. So this was introduced to curb the tax evasion. But sir, here the time period is 12 years. What Mr. A should do? Mr. A should lease the property for less than 12 years. Let's say for 8 years. And further for 8 years. No dear, this is not so easy. Assessing officer will immediately club these two periods and will say this is a combined lease for 16 years, and as this exceeds 12 years, hence Mr. B will be considered as a deemed owner and the income will be taxable and their house property. But yes, one exception has been given. What in case the person to whom the property has been leased, if the lease is on a month to month basis, means for every month you are making the lease agreement. Sir, are you insane? Who is going to make the lease agreement a month to month wise? Okay. Or for a period not exceeding 1 year, means 1 year lease rent, 1 year lease agreement. Means if Mr. A is renting the property to his brother B, then for every year he has to renew the lease agreement. Still, assessing officer can invoke the deemed ownership provision. So this is not so easy. But anyhow, 12 year is a period, and if the lease is for from month to month basis or for a period of not less than not exceeding 1 year, then the deeming provision won't apply. Okay, we have taken a lot of time, which I was not expecting. Anyhow, dear friends, do give us a favor, do like this video and do share with your friends. By